the shadow banking system that grew in the dark. In March 2020, the safest markets in the world began to behave as if nobody trusted anybody. Investors rushed for cash. Treasury trading became disorderly. Money market funds came under pressure. Mortgage funds sold assets into falling prices. And the Federal Reserve moved with extraordinary speed, not only to protect banks, but to stabilize a vast financial system operating beyond traditional bank balance sheets. This was the shadow system built during the age of easy money. The phrase shadow banking sounds criminal, but most of it is legal. Regulators now prefer the term non-bank financial intermediation. It includes money market funds, hedge funds, mortgage companies, securitization vehicles, private credit funds, and other institutions that move savings into loans and securities without operating like ordinary deposit-taking banks. These firms can make finance faster and more flexible. They also create a basic vulnerability. Many promise investors quick access to cash while holding assets that may be difficult to sell during a panic. To understand why the system grew, return to the years after 2008. Central banks cut interest rates towards zero and purchased enormous quantities of government bonds and mortgage securities. The policy helped restore credit and support recovery, but it also pushed yields lower. When safe assets paid almost nothing, investors searched elsewhere. Pension funds, insurers, endowments, and households wanted higher returns. Money flowed into corporate bonds, leveraged loans, real estate vehicles, private credit, and funds using borrowed money. The search for yield became one of the defining behaviors of the era. Traditional banks were also more tightly regulated after the financial crisis. Higher capital and liquidity standards made the banking core safer. But financial activity did not disappear. Some of it migrated into funds and financing structures that faced different rules. The result was not one shadow bank. It was a chain. A company borrowed through a leveraged loan. A fund purchased that loan. Another institution financed the fund. Derivatives transferred some risks and created others. Short-term lenders supplied cash against securities as collateral. Every link looked manageable in normal conditions. The danger appeared when everybody wanted liquidity at the same time. Imagine a fund that lets investors withdraw daily but owns bonds that rarely trade. When redemptions arrive, the fund sells its easiest assets first. Falling prices encourage more withdrawals. Soon, it must sell harder to trade holdings at discounts. Those sales push prices down for every other fund holding the same assets. Leverage accelerates the process. If an investor borrows to buy $100 of securities with only $20 of its own money, a relatively small decline can trigger a margin call. The lender demands more collateral. If the investor cannot provide it, assets are sold immediately, often into the same falling market. This is how a liquidity problem becomes a fire sale. The pattern has appeared repeatedly. During the 2008 crisis, securitization and short-term wholesale funding transmitted losses throughout the system. In March 2020, the global dash for cash hit Treasury, corporate bond, and money market funding. In 2022, leveraged strategies used by British pension funds amplified a sudden move in government bond yields, forcing emergency intervention by the Bank of England. Each episode looked different. The underlying mechanism was familiar. Liquid promises resting on less liquid assets, connected by leverage and confidence. Easy money did not create every weakness. But low rates made leverage cheaper and encouraged investors to reach for returns. Rising asset prices made the system appear safer because collateral values kept increasing. Stability itself encouraged greater risk. Then, the policy environment reversed. Inflation forced central banks to raise rates rapidly. Bonds lost value. Refinancing became more expensive. Commercial real estate faced pressure. Private companies that had borrowed during the cheap money years confronted higher interest costs. Strategies designed for calm markets encountered a world of larger price swings. The shadow system did not vanish, it grew. According to the Financial Stability Board, non-bank financial intermediation expanded by 9.4% in 2024, twice the growth rate of the banking sector, and reached $256.8 trillion, representing 51% of global financial assets across the jurisdictions it monitors. Size alone does not make the system dangerous. The real questions are leverage, liquidity, and connection. How much money has been borrowed? How quickly can investors withdraw? How difficult are the underlying assets to sell? And how directly are funds connected to banks through loans, deposits, derivatives, and securities? Those connections explain the modern central bank dilemma. Authorities may insist that investors should bear their own losses. But when forced selling threatens the wider system, intervention becomes difficult to avoid. Support can stop a panic, yet repeated rescues may convince markets that risk will eventually be protected. That belief is one of the deepest legacies of easy money. The age of low rates changed more than the price of borrowing. It changed where risk lived. After 2008, banks became more resilient, but leverage and liquidity risk migrated into a broader network that was harder to see. The next crisis may not begin with a bank run at a branch. It may begin with a margin call inside a fund, a rush out of an investment product, or a market that suddenly has no buyers. The system is called shadow banking, not because it is invisible, but because the light reaches it only after something starts to break. In the next episode, why weak economic news became good news for markets, and how investors learned to trade the Federal Reserve instead of the economy.